Price. Let's navigate our conversation now to Amit Jeswani, the founder of Stallion Asset. Hello there, Amit. How are you doing?
Good morning, Nikki. I'm doing well. Good morning, everyone who's watching this show. A happy new year to you.
All right. Happy New Year to you as well. I'm just going to start off with, what do you make out of the IT read-through? Like I was just discussing with my colleague, that after quarters and quarters of disappointment, finally we've seen some amount of outperformance that has come through from the IT sector, both from TCS as well as Infosys. What is your read-through, and which are the stocks that now you would be looking at, given that, you know, IT sector has managed to deliver or surprise on the upside?
So, Nikki, for us, it's very important to back minimum 15% kind of growth rates. And we don't find that in the tech space right now. So we will stay away. We don't have any large allocation towards tech services as of today. We like players like Persistency. You're in India for playing growth, and this 2%, 3% kind of growth, beating estimates by 1%, 0.5%. This is not something that we, as our investment framework, doesn't allow us to do all this. We want a secular 20-25% growth, and that we don't find in tech services, at least now. So we've stayed away from tech for some time now. But we like companies like Persistent, GoForge. Of course, we are a SEBI registered PMS and a research entity, and these are not recommendations. Me, my family might have vested interest in whatever we speak today.
Disclosures there, well taken.
One of the biggest bull market of our lives. Why do we look also in companies that are growing at less than 10-15%? We should not look only, because there are 5,000 companies that are listed, and we want only 25 players in our cricket team. Our portfolio is like a cricket team, right? And we need 25 good players. We should not, like, this is not our cup of tea to look, unless it's extreme cheap. When you buy it with extreme cheap and very high neglect, that's the only time these kind of stocks with less than 10% growth make very high alphas for you. Or else money doesn't get made here. And now also Infosys or a TCS is about 40% valuation premium to pre-COVID levels. And the growth rate is broadly same or similar pre-COVID growth levels. So I don't find a reason, like, it's not part of our frameworks.
Okay, that's almost dashing up a little bit of pleasant surprise that the sector otherwise did manage to witness today. But point well taken. Which are the areas of rather just say value buying that one can look at now, or valuations which are perhaps a little more cheaper? Look at large caps. They're also trading at a 5% premium as compared to the historical averages, despite the whole narrative that large caps are the ones that we need to perhaps now look to, probably lap up, because mid caps and small caps perhaps would see some amount of correction. But themes that you're looking for?
See, Nikki, you want market leadership and 20% growth. That in large caps is there. If you see the entire large cap space, more than 1 lakh crore companies, there are about 59 companies, more than 1 lakh crore market cap as of today. And the ones who are growing at 15%, 20% plus would be Titan. Titan's already come with numbers, 23% growth. We might have vested interest. Then you have Varun Beverages, which is growing at 25%. REC at about 15%. So you have to, ICICI Bank should do about 20% growth. Bajaj Finance has come out with 35% growth. You have Indigo Airlines, which should generate, in the first half of 2024, it generated 8,000 crores of free cash flow. And in the first half, in 6 months, it generated 8,000 crores of free cash flow. And today, market cap of Indigo is 110,000 crores. It's market leader and gains market share every year. Pre-COVID, international airlines market share was 3%. International, like the ones who travel abroad, their market share was only 3%. Today, it's near 20%. So these are the companies who are scaling very well. And that is where I would say that focus should be companies who can scale up. Even in large caps, you can make very large, very decent money. Like our portfolio is typically exposed 50%, near 50% to large caps. And large caps have also generated for us very decent returns. So if you can find growth, reasonable valuations, good money will get made in large caps this year. But if you buy 4%, 5%, 7% growth companies and 3-4% dividend 2% dividends, 3% dividends, then your returns will be according to the growth that they generate. Because mostly these are very efficient companies. So find growth, companies who can make it large. This is India's decade. And why do you want to, in India's decade, why do you want to be in companies which grow at 5, 7, 10%? Be in high growth companies who are going to make it very, very, very large, and keep tracking. Till the time they're growing, be with them. When the growth stops, you come to know every 90 days, whenever the growth stops, you move ahead and find something better. It's like a cricket team, you have to replace. If one of your players is injured, you replace it with some other player, and the game keeps going on.
Chasing the multi-bagger stock and the high growth stock, there's also a story which unfolds there. Polycab, it's a 10-bagger stock since its listing in April 2019, and we've seen the shares fall 21% in the biggest single day drop since listing. A bit of notices around, a bit of media reports doing some rounds, the company refuting the rumors. Looks like a corporate governance issue at the face of it, but is not really flagged as one. What are you reading into it, and how are you looking at companies like this?
So we might have vested interest here, Nikki. That's the first disclaimer I would like to make. Me, my family, my clients. And we keep going up and down in all our stocks that we have in our portfolio. So we keep buying, selling. But I would say this issue looks like to be, see, there are instances where IT raids have happened. Like I remember we used to, I'll give you an example. Like in 2021, Ratnamani Metal, and that time crude prices were going up. That was the time inflation was going higher, crude prices were going higher, and we were looking at companies who do benefit from crude oil. And that time IT raid happened. The same thing happened. 400 crores of undisclosed revenue, etc. The stock has moved from 1100 that day to about 34, 3500. I'm speaking about Ratnamani Metals and Tubes. It's all about earnings. As of today, the market cap of Polycab is about 58,000 crores. If this year they can do decent, 18th is the numbers for Polycab. We'll come to know what they've done this quarter. If this analysts were expecting about 1,800 crores of profits, so Polycab would be near 31, 32 times. If there is no large problems on the numbers, because the problem is not under-reporting revenues. The problem is not over-reporting revenues. The problem is under-reporting revenues. It's a different kind of problem that we are hearing about, that revenue should be 1,000 crores higher. So let's see what happens, and we may increase, decrease allocations based on earnings and based on what happens. It's a very high news-driven counter as of today. I don't like so many B2B in such high news-driven counters. But let's see, the things have gone out of proportion here. But we will stick, see 30p, the markets for now has discovered that 31, 32p FY24 to be the base. And 2 years from today, no one remembers anything. Like I don't even remember who speaks about what rates happened last year. Not one person even remembers how many companies got rated last year. So things move on. If earnings are okay, you have KPMG as the auditor. I hope they've done a good job. And 18th is the numbers. Let's see on numbers. If numbers are good, we'll increase, decrease positions like normal. For life moves on for us. So there is nothing, nothing that impacts. Like the game change, the process that we follow doesn't change.
Okay. So in your PMS, what % of shares are you, holding this Polycab, and also what kind of earnings might just throw you off? Like you've said, that you're pretty quick with the rotation and the churn out. So what numbers are the numbers typically, or the growth figure that seems disappointing and you will probably exit your position or perhaps accumulate more? Or what is that criteria that you're working with?
You're asking me tough questions, Nikki, but it's about 2.8% of our portfolio. 2.8 or 2.9% of our portfolio as of yesterday. So it was 3.5% of our portfolio. Yesterday, it was down to 20%, so 70 bips off. But we still closed positive yesterday, so I don't have a problem. So we lost probably 70 bips on our portfolio. So start of the month, it was higher at 8%. When the news came, we do typically trim. There are risk management systems. So we've got a lot of processes to make sure that we are safe all the times. My clients are safe. That is prior, very important to us. But as of yesterday, before the 20% fall, we had only 3.5% weight. So yeah, and we lost 70 bips, but we still closed positive yesterday also. So it's okay. It happens with us all the time, and life moves on, and we still do well. So, and last year we were up 59%. So all this 1% here and there, it doesn't make an impact.
Okay, so disclaimers taken well there, but let's also navigate our conversation more towards the value buys that you were perhaps hinting at within the large cap space. You said, why just look at IT? Look at other names perhaps where there is more value, and within the large cap category, which is the space or the pocket that you think now holds more value? Is that discount as compared to the historical averages, or for that matter even peers?
See, it's not just large cap. I would say it's across, and I wouldn't say that small caps will fall only because if there is earnings growth of 30%, you need to look across. If you get consumer facing company, don't go B2G and everything we don't do, it's out of syllabus for us, so we don't do. But if you get a consumer facing company which can grow at 30%, 25%, this is India's decade with multiple 20% corrections in between. You want to be with these leaders, these market leaders. You have to look at, like on your Diwali day, I spoke about one food delivery company. Then I spoke about one exchange, the commodity exchange. We have Angel in our portfolio, which has doubled in a quarter. Capital market, every quarter you come to know what is happening. And very decent scale-ups are happening in the capital market space, Nikki, and very large wealth creation. You see, after multi-year, this thing, so many stocks are breaking out. Yesterday, HDFC AMC numbers were good. Nippon did a block, and that is breaking out. You have to look that after many years, there's a very decent breakout which is happening across the entire sector, and you don't miss that. But we are also increasing defensive weight. So we have added one hospital in our portfolio this quarter. We have, so we are adding some hospital kind of plays. But the growth is again 20-25%. If I get 20-25%, I'm very happy. My clients are very happy at reasonable valuations. That company does ROE of 31%. It's got 5,000 beds, growing at 20%. That is what you want. If you want to be in defensives, and it's trading at 31p.
In that case?
Sorry?
Are you talking about Apollo Hospitals?
No, it is not a 31p Apollo Hospital. I'm speaking about Narayana Madralaya that we added last quarter.
That's exactly, okay.
And we got a decent this thing. And on one side, where we are playing high growth, and high growth, we want that those are emerging monopolies. See, we divide our portfolio, Nikki, in three parts. One is emerging monopolies. These are companies where we want 30% plus growth. 25-30%. They're market leaders or number two, and they're growing very, very, very fast. The second side is proven monopolies. These are companies who are very proven, and we are happy if we can compound at 20%, and we keep decreasing. Example, I'm just giving you an example. If Bajaj Finance comes near 6 times price to book, we might buy. It goes to 9 times price to book, we may sell. If Nestle comes to near 70p, we will buy. At 90p, we sell. Well, while the growth of Nestle is 12%, my returns on Nestle are higher because on lower prices, I'm a buyer. On higher prices, we are sellers. And then we have special situations. In special situations, we have stocks like Red Tape that we added. We increased our allocation this quarter. So we started with decreasing our allocation because the numbers were bad. But over time, we realized that if we get it right in Red Tape, we will make it large. So we added Red Tape. We increased our allocations in Red Tape. That's a special situation that we've been owning for 8-9 months, but we've added more allocations, I would say, this quarter.
Okay. Amit, in this earnings season, of course, it started on a good note, of course. We have got some surprise coming in from IT sector. Which are the sectors that you think probably now will rather give us that surprise in terms of perhaps a rating upgrade too? Which are the pockets you're looking at, and which are the stocks essentially that you're within that sector particularly studying or for that matter just analyzing?
See, I'm studying pipe companies. That is where hyperscaling is happening. Be it, I'm just studying them. I don't know if I'll buy them or not, but I'm studying pipe companies. I'm studying telecom companies. I'm studying. We meet so many people, Nikki. It's unbelievable the amount of people we meet in a typical week, and then we decide that where we want to be in our portfolio. So where would be their massive beats? Everything is discounted in the market. There is nothing which is not discounted in the market. The market is too smart, Nikki, and you have to. We are. If you cannot, this earning season, when I come to you next time, you call me during the earning season. Today the earning season for me is not even started. Because I didn't have positions in TCS or Infosys. So for me, earning season starts today. Today are the first earnings. But I'll tell you, updates have been good. I have not seen a bad update this quarter from like FMCG. We've seen bad updates by Marico, etc. But that we don't have in our portfolio. But if you see the entire update season, be it financials, be it consumer companies, jewelry companies, Kalyan Jewelers growing at 40%. We missed that trade, but growing at 40%. Senco Gold grew at 24%. Titan grew at 23%. People are not buying shoes. People are not buying clothes. They are just buying gold. I don't understand what is happening in India. so, while one side of the market is super, so that there are pockets, and you have to be in the right pockets to make it large this time. It's not going to be like an overall sector doing very well. It's pockets of growth within a sector, and like in cement also there'll be something that'll be doing well. So it's you have to be a little more micro. But we are in a bull market. Even if you're wrong, market gives you enough opportunity to get out.
Okay, so Amit, typically you've said FMCG, perhaps consumer staples, consumer discretionary is where you're going to be looking at. Within the earning season also, will these be the bets that you'd be looking at, or this is, perhaps not really seasonal in nature and perhaps just a valuation play for you?
No, in a consumer and consumer discretionary, it's all season, so you don't have to worry too much about. It's not like now, right now, it's not like chemicals that it'll do well for 2 years and to go badly. It's not like these API plays. Consumer is all season, bull market, bear market. You just have to chase growth at reasonable prices there, and you want to chase high growth. And I think, and you want to pick your stocks very smartly, and you want monopoly. So my consumer holdings are across electronic retailers, watch retailers. There is so much. India is moving from $2,200 per capita to $5,500 by 2030 or 2032 or 33. Doesn't matter, but that thing will happen. And when that happens, my stocks should do hopefully well. And that is where you will not lose money also, and you can get exits also. See, Nikki, for me, exits are also very important, because we will buy very large quantities. In B2B companies, 2 quarters are bad. No one will look at the stock again. In B2G, in 1 quarter also is bad. I don't think so. The story ends. So, and there is no buyers left. In consumer, the story is very, very, very long. So there is longevity. There is a large terminal value. So even if you go wrong by 2-3, like if your earnings are bad by 2-3 quarters, nothing happens to your terminal valuation. So that is why you would be seeing very large guys who've made it very large across world. I have made it large in consumer companies and consumer tech companies, be it Warren Buffett right now. And even prior to that, Warren Buffett, be it Walmart, Tesco, all these, what has happened across the world will happen in India. Nothing changes across the world. And big money will be made in consumer related, say, be in consumer, pharma, technology, and financials. These are 4 places, and some manufacturing. And these 4 or 5 places is where largest money will be made. And you can compound it. Like last year, Nikki, I'll tell you, it was a very tough market for growth investors like us, because all value companies did well, REC, PFC, etc. But that year also we did fairly decent, and our alphas were 34% last year. Not bad in a year where value has done well.
Okay, Amit, 2 questions there for you. A, what do you think could be the alpha generator for 2024? That is one. And B, what do you think about typically companies, or just to say banking space, the private sector bank and the public sector? We've seen enough and more run up. at least private sector bank, the thesis is it's going to catch up after the rally that we've seen for PSU. Valuations still remain a little bit expensive for the private sector banks. But you think this time around it's going to be a performance which is driven by private sector banks?
So, Nikki, I can tell you about my frameworks. There are 3 companies. I'm sorry you're asking me about public sector and private sector, but we work more on frameworks because we don't have to have a view on everything. We have to have a view on what is historically done well and what will do well. We need 3 things in finance. You want high growth, low credit cost, high AUM growth, and a management you can trust. When you get 3 things, that is where you put your money, and very high ROEs. Four things. High ROE, high growth, management you can trust, and low credit cost, low NPAs in bad times. And COVID was the worst time. You've seen every company, how they have reacted in bad times. Valuations aside, in financials, valuation is not the only metric that works. In fact, I would say it's the last metric that one should look at. The first one is quality of books. You're taking leverage of 6, 7, 8 times. What is book value worth if your default rates go higher in bad times? It goes to 0, right? So we have 3 companies in financials, like large exposure. We have 4 actually, but we have one which is Bajaj Finance. One, we have 5-star, which is growing at 40%. And then we have one small microfinance player. These are the only companies I would say that we have exposure towards in the lending kind of business. And we have ICICI Bank also, but that is for NRIs and smaller weights. But these are the only 3. My financial exposure is less than 15%. I don't want to be more than 15-20% in lending businesses. There's so much growth elsewhere. And who's going to take every day? There's just so much opportunities available, Nikki. And
so just speaking of opportunities, Amit, we are completely running out of time, but I still want to squeeze in this one last question and perhaps 30-40 seconds on this one. In the run-up to interim budget that we're looking at, you think power, defense perhaps would be the themes that you need to watch out for? Are you still gung-ho on those themes? What is going to be your wish list looking like in the run-up to budget, or stocks that you will keep on your list in the run-up to interim budget?
I don't think my portfolio will get impacted. Good budget, bad budget, 1% plus minus. But coming to all these stocks, power stocks, I agree there's a very large trade which is happening. It's an melt up which is happening, especially towards the renewable guys. There are 2 kinds of people. The thermal guys were always dependent on coal supply. Your ROEs were very volatile. But now the renewable guys, if you're reinvesting your thermal cash flows in renewable is not dependent on anything. It's just dependent if the sun will come or no. And you've got 15-20 year contracts. And your regulated ROEs are 15%. So power is going through a massive change, I would say. That is one sector. Defense, of course, the large players, the large caps, defense stocks should do decent. They will not correct. This is a regime change which has happened in India in B2G companies. Some of them, the ones who are not leveraged, they will keep going. We will remain positive. The non-lending ones. Lending, I have no views.
All right, Amit, we'll just leave it at that. And thank you so much for offering that different perspective to us as always.
Thank you.
All right, that's all that we have in this edition, completely running out of time. But with this, it's a wrap. And goodbye from the entire team who put this piece together just for you. And thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.